So, this week's market outlook. Starting off with the overview. During the start of last week, we saw lower US yields and higher equities as forecasted due to risk on dominated flows from the agreement being signed in the Middle East. On Wednesday, we had the FOMC meeting, which resulted in a massive hawkish repricing across the front end of the curve. This led to equities and high beta currencies taking a hit while supporting the dollar. So that's essentially what happened last week, FOMC wise. Politically, Andy Burnham in the UK won the Makerfield by-election, which has now mounted more pressure on PM Starmer to resign, and as a result we are seeing the long end of the curve spike slightly higher. And since I wrote this, I believe this morning, we'll go over it in the pound section, but it is set that markets or the media is expecting Keir Starmer to actually resign by Monday, which is obviously going to be very negative for the UK 30-year yield, and it should mount pressure on the pound. So yeah, that is essentially what we're looking at politically wise in the UK. And then over the weekend, we have seen some tension build up in the Middle East between Lebanon and Israel. However, the government has just landed in Switzerland, indicating that the deal is more likely to get signed. And I do believe this is somewhat priced in at the moment. As you can see from like oil's movements last week, it's been the whole of last week, oil's been taking a hit, and that is the market rapidly pricing in the Strait of Hormuz being opened, which obviously comes from this deal, and also a lot of just softening tensions in the Middle East. So yeah, that's essentially the overview for this week. Moving on to the calendar. So this week in the calendar we have on Monday inflation data coming out of Canada. Tuesday is a big day for PMIs. We're getting European PMIs, Australia, Japan, US, UK. So yeah, big day for PMIs. Then on the Wednesday we have inflation out of Australia, which is forecasted year over year is forecasted to actually increase by 10 basis points, whereas the month on month is expected to slow by 80 basis points, which is quite a lot. We'll see how the short end takes that if it comes in at that price or that level. Thursday, we then have not much. We've got some durable goods orders. I believe we have PCE on the Thursday. And then obviously GDP growth quarter on quarter estimate, which is forecasted to come in very nicely at 1.6%, which is going to support our long dollar thesis into the print. So yeah, that's Thursday. And then on Friday, we essentially don't have much. It's a very quiet day of just some medium impact news. So yeah, that is what we are looking at this week on the calendar front. Moving on to the currencies. So starting off with the US dollar, as mentioned, we are bullish this week. It's essentially mainly being driven by short-end treasuries at the moment. And as mentioned, last week's FOMC meeting came in extremely hawkish, pushing the short end of the curve 36 basis points higher. The macroeconomic data in the US remains somewhat strong with this week's PCE data forecasted to come in 10 basis points higher. And obviously, as we just mentioned, the GDP estimates quarter on quarter is forecasted to come in a lot higher as well. So yeah, it's pretty simple on the dollar this week, mainly being driven by short-end yields. If we look at the institutions, we can see that Bank of America remain long on the dollar, HSBC remain long on the dollar, Citibank long on the dollar. Did we go over JP Morgan? No. JP Morgan are also long on the dollar. Obviously, the Fed's hawkish committee stance, give it a pause, have a read. But yeah, the institutions, the consensus among these institutions is essentially a very positive dollar for the week ahead. So that's what we're looking at on that front. So moving on to the pound. So this week on the pound, we are bearish as we were last week. Obviously, last week was very full with data. We had inflation, labour market, and also the Bank of England rate decision. Overall, the data came in pretty soft, pushing short-end gilts lower. Gilts had a slight bounce on the lower timeframes following Friday's victory of Andy Burnham, which obviously spiked yields, which is especially for 30-year, which is why we saw a little pickup in the 2-year. We didn't see the pickup in the 2-year because of inflationary concerns or a hawkish Bank of England. We saw a little spike in the 2-year because of the 30-year and because of political risks. obviously investors demanding more of a yield for giving their debt to the UK, or for buying the UK's debt, I should say. So that's that. CPI came in at 2.8%, which reinforced the slow and gradual pace of the Bank of England, and the market having a slight dovish repricing proves that. The labour market's print was also pretty quiet, and then the Bank of England meeting itself swayed more neutral. So yeah, quite a very packed news week for the UK, but I think the fact that gilts, especially in the short end, ended the week a lot lower tells you that the data was pretty soft. Institutionally, on the pound, I believe Credit Agricole are bearish on the pound. JP Morgan are also bearish on the pound, a cautious short. And then MUFG as well, actually, are also short on the pound. So yeah, and obviously this is based off the Bank of England meeting where they say Bank of England drops rate hike expectations. They see this as negative for UK yields and the pound. So yeah, that is what we're looking at on the pound. Actually, if we go back, we can see here that asset managers are increasing their short positions. They're already overall very short on the pound. And we can also see that leveraged funds are increasing their shorts or reducing their long positions in the pounds. So yeah, we can kind of get an idea of where the institutions are moving. Moving on to the euro. So with the euro, it is dependent on the cross for us. Europe's economy isn't anything special by all means. Obviously we have PMIs this week, which we'll get into, but rate differentials on specific crosses such as Euro NZD, Euro Pound, Euro Swiss are extremely appealing. It's very much dependent on the cross, as we have been for a good few weeks or even months. PMIs are the main focal point this week for Europe, with the majority seeing an improvement from last month's print, which should support the euro into Tuesday's data releases. Institutionally, obviously, JP Morgan are bullish on euro pound, as we've just seen, however bearish on euro dollar. So it's very much consensus among institutions that it's very dependent on the cross for sure. So yeah, that is where we are at on the euro. Moving on to the CAD, we'll keep it very simple. Canada's short end is drifting lower amid softer economic data and more dovish Bank of Canada. Coupling the falling US oil prices, we can expect to see the CAD weaken off, in my opinion. The main data point this week is inflation on Monday, I believe. If we actually have a look here. Yeah, Monday. Which is expected to remain somewhat flat, hovering around the 2% year-on-year level. Institutionally, JP Morgan are bearish on the Canadian dollar, as we just saw in the insights page. So yeah, bearish on the CAD this week. I mean, if you just take a look here at the CFTC positioning as well, asset managers are net short, and they're increasing their shorts massively, 20,000 just in the week-on-week change. Leverage funds also massively short on the CAD, and their week-on-week change is also increasing their shorts. So yeah, I mean, seasonality wise, I don't typically use this all the time, but in June we see a weak month for the CAD. So yeah, that is essentially where we are at on the Canadian dollar this week. Moving on to the Australian dollar. So ES shrugged off last week's hawkish FMC meeting minutes, which is inclining me to expect to see equities continue their move to the upside this week, which should lend the AUD some support. Last week's RBA meeting tilted more hawkish. The bank pushed back against expectations of near-term rate cuts, signalling that bringing inflation back to target remains its primary focus, despite signs of slowing economic growth. Coupling together the decent economic data, more hawkish RBA, and obviously risk sentiment bouncing back, I do expect to see the Australian dollar outperform this week. If we look at the institutions on the Australian dollar, we'll be able to see that JP Morgan are bullish on the Australian dollar against the euro and the New Zealand dollar. And I believe it was MUFG. Yeah, they're also long on the Australian dollar. So yeah, that is what the institutions are looking at this week, and we agree, we are bullish on the AUD. Moving on to the New Zealand dollar. We are bearish this week. The New Zealand 2-year has been tracking softer US oil prices fairly closely, with lower energy prices easing inflation concerns and reinforcing expectations that the RBNZ can remain on a more accommodative path, so to speak. As a result, New Zealand's short-end yields have continued to drift lower. I also think external factors are important, so recent dollar strength has obviously weighed on the Chinese yuan, reducing support for China-linked currencies, such as the New Zealand dollar. And then given New Zealand's close economic ties to China, this remains an additional headwind for the New Zealand dollar for sure. From my perspective, the combination of softer oil prices, subdued inflation expectations driven from the oil prices, and then weaker China-related flows just points the New Zealand dollar to the downside for me, at least. Institutionally, if we look at what they're saying, we can see that the Citi are bearish on the New Zealand dollar. We can see that JP Morgan are also bearish on the New Zealand dollar, obviously against the Australian dollar in this case. So yeah, that is essentially why we are bearish on the New Zealand dollar this week. Now moving over to the Swiss franc. We're skipping the yen this week because, I mean, we're bearish, but the intervention risks are super high right now. So personally, I'm going to leave it. Swiss franc, we are also bearish. We believe that the SNB's decision last week was barely impacted short-end Swiss yields, leading to it pretty much being a non-event. Gold is continuing to descend as yields, specifically the US's, rise from their FOMC meeting, of course. So until we get some news regarding the US economy, which hits short-end treasuries, I do believe we will continue to see Swiss franc weakness. Institutionally, if we check that out, we can see that JP Morgan and Citibank. So Citibank are short on the Swiss franc, and so are JP Morgan. So yeah, that is where we are at this week with all the macro. Moving on to the technicals. So starting with the DXY, we are obviously bullish. We remain bullish. I think this level here is very nice. If not, probably the 1025 is the most appealing. If I can move it there. Around here, this level here is very appealing for further upside on the dollar. Moving on to the actual pairs, we'll start off with dollar yen. As mentioned, this whole box we're in here, this level here, super elevated intervention risks. So personally, I'm going to be leaving it. I've got this level marked out here, which potentially could get in for a 1-to-1 if we wanted to be a bit risky, get in and out. But otherwise, I feel like these levels down here are a lot nicer for sure. So yeah, that's dollar yen. Dollar Swiss, these levels here I like. We've got this demand zone here, and we've got this demand zone here. Let me get rid of these. This demand zone here and this demand zone here for upside. That's what I like the look of. Dollar CAD, I just think we're so overextended. For me at least, we're either going to have to... What will most likely happen is we'll actually see some structure get built here. We'll have a rejection, and then we'll come back down, and then we'll go. That's what I like the look of. I really doubt that will come back down here to the 13975. So yeah, that's dollar CAD. GU, this level here, 133. NU, take out this Asia high, getting around the 5775. That looks quite nice. EU, similar thesis, 115. Euro CAD, I do like this 162 level. Euro pound, I think, given the news over the weekend of the UK's political risks and the fact that Starmer is most likely going to resign, we'll probably bounce off the open, which is annoying because I really wanted to get in at this level on the Friday, but market's obviously closed. So I think something like that. If not, this level here looks amazing. Euro NZD, got caught out on Euro NZD last week on this short, got a bit too greedy on the Monday, trying to get in on the risk on flows, but then adjusted our bias and ended up bagging 2 winners. So New York low getting taken out and then bouncing off this demand here. That's what I'm looking at, the 199, just below the 1995. Euro AUD, we've obviously taken out this weekly low, so I think we're going to get a nice a nice pullback into a decent level, either this level or this level here. I mean, if we just have a look, what is that? That's a London high. So we could sure enough see this get swept before we go lower. Euro Swiss, I really like this level here. Beautiful play macro wise. AUD CAD, I think we could get in at the 991. However, I'm most likely going to get in at the 99, just below the 9905. I want to see the London low get taken before we move higher. AUD NZD, similar thesis. This level here looks quite nice. AUD Swiss, this level here, I mean, I'd probably take out this low here before we go higher. Yeah, that's what I'm looking at. And then finally, GA, I closed this before market close. I mean, this still makes sense. However, this level up here is really nice. I'll 1,000,000% get in on this level up here, 1,000,000%, and it would be very nice, equal highs wise, to get in, because you've obviously got this US New York session high there, and you've got this London high here. So it takes out both those. Then we tap into this level. That would be ideal for sure. So that's all the FX. If we go into gold, actually, I had something set up here for once. Bit higher time frame for sure. I like this level here. But if we come back up into this level, this will be good for sure. However, the thing with gold is it's so reactive to yields at the moment. So you get big moves. You don't get it's not the cleanest price action for getting in on like pullbacks. But that's gold. And then ES, I've got these two levels marked out. This level here, this level here, this level here. I mean, this level played out amazingly on the Tuesday. But this was 2 weeks ago, I believe. Yeah, the Tuesday 2 weeks ago. I mean, if you held that, you probably would have hit for a 1 to 4. But yeah, this is what I'm looking at this week, technical-wise. So yeah, we'll catch you in the next Outlook. Drop a like, and we'll see you next week.